I want to bring in Lauren Goodwin, New York Life investment economist, chief market strategist this morning. The markets have even moved around a little bit this morning, perhaps even on the back of this news report. I don't know how much you think by Time Magazine with this interview with President Trump. Of course, the interview suggesting that he's prepared for tariffs as high as 50%. Nonetheless, it appears that the interview was actually conducted back on Tuesday. How do you think the markets have mathed out, or what's baked into the cake of what tariffs ultimately look like, Lauren?
I don't think the market has any idea where tariffs will land, and frankly, neither do I. I do expect that the worst of the news for tariffs is probably in for the market, but there's a couple of things that we're seeing in terms of the way markets respond that make me fairly confident that these volatile periods will continue. The first is that hanging on every word of the administration is frankly disruptive for the markets, because whatever the change in sentiment might be, investors are extrapolating it out 1, 2, 3 years, and so you get wild swings as a result. The second thing that's happening since the sort of policy stability of the end of the year is that we're seeing correlations between asset classes rise, and specifically stock bond correlations rise. And so the diversification that you would naturally get or expect to get from a 60-40 portfolio, investors aren't seeing that either. Now, I don't expect the underpinning elements of those things, policy uncertainty, concern about inflation and slowing growth, I don't expect those to go away over the next several months. And so I think we'll continue to see the markets try to make the math right. and see volatility as a result.
How do you think the Fed plays all of this? Because there is a backward-looking element, so they're going to wait for the numbers. They've said repeatedly they're going to wait for the numbers, but the question is whether they're going to be too late in terms of waiting for those numbers.
Yeah, the Fed's going to do as much as they can to do as little as possible for as long as possible. And I think it's fair to say that if you're looking at policy ahead and trying to determine whether it's appropriate for this volatile period, might you want to look forward a bit and try to understand how the economy might react to uncertainty rather than look backward? I think one of the reasons why the Fed can justifiably say, look, we need to see a deterioration of growth before we'd even consider a cut in interest rates, there's a few reasons for it. First, interest rate policy coming into this year, most investors weren't quite sure that it was even restrictive to begin with. And so we're not looking at a policy rate that's meaningfully constraining economic activity. Instead, what's constraining economic activity, at least what we expect, is a supply side shock. There's not a whole lot that the Fed can do about that. Another reason why the Fed is likely to try and wait for the hard data on growth, even if that puts them a little bit behind the curve, is that we know inflation is still a threat in this economy. And so the concern that the Fed has about that side of their mandate for the time being is trumping the concern that they might have about growth.
All right, well, Lauren, then the question is there a Fed put on this market? And maybe the question is there a Scott Bessent put on this market?
I think we learned last week from Chair Powell's comments that if there is a Fed put on the market, it's at a lot lower values of the S&P 500, higher values of U.S. 10-year Treasury yields than maybe the market was hoping. And so, you know, I do believe that financial conditions will be a swing vote between the Fed's two mandates. If they're focused on inflation, haven't yet seen the growth data, but we see financial conditions deteriorate meaningfully, I think we could see them step in. But the levels at which they'll step in, I think, are more extreme than the market was anticipating. When it comes to the administration, though, I do expect that the word from the administration on tariffs is more live. We've seen reactions more quickly. And highly relevant.
Lauren, want to thank? Oh, go ahead.
You're right. But Bessent does seem to be a very calming force for the markets and steering things in that direction. Do you think there is a Bessent put, as Andrew suggested?
I think there is, and we saw that activate a bit last week as well when the 10-year Treasury yield moved up higher than 4.5%. The administration was uncomfortable with those levels. We know that keeping rates at a more moderate level and the market rates that the administration has more say effectively in navigating, we know that that's an important policy goal. And so I believe not only does the administration have a role to play in stabilizing the markets, but that activity has come a little quicker as a result of how their goals are impacted by market levels.